last part of this monster chapter, self-employment tax. I'm seeing nods. Yes, it's a monster chapter. Self-employment tax. So the good part about this is you actually, for everybody who's taken payroll tax, which I think is all but maybe 2 of you have completed it, but we've already talked about self-employment tax. I think May is currently in the payroll. You will be in payroll. The rest of you are already familiar with self-employment tax. So you know that self-employed individuals have the privilege of paying both halves of FICA tax, the Social Security tax and Medicare tax. So remember, I'll put this, a lot of you have already seen this, employer, employee, total. We have a couple different types of taxes here. We have Social Security, and this is all FICA, under FICA taxes. So Social Security, which is otherwise known as OASDI, Old Age Survivors and Disability Insurance. The tax rate for an employer, for an individual who is an employee, the tax is paid half by the employer and half by the employee, right? For a total of 12.4%, not a small chunk. And then we also have Medicare tax, otherwise known as health insurance, 1.45% and 1.45% for a total of 2.9%. And then we also have additional Medicare tax. Put this down a little bit. And this is paid only, the employer doesn't pay any, but the employee pays 0.9%, so a total of 0.9%. Social Security, well, let me go back a second. So the total that's paid by the employee and the employer is here. I'm going to put this, so this is 15.3%. And then if you are subject to additional Medicare tax, it's an additional 0.9%. If you are self-employed, otherwise known as SECA, so FICA is for individuals who are employees. SECA, Self-Employed Contributions Act, you pay both halves of that tax. It's not a small amount. It's pretty substantial, 15.3%. Now, Social Security applies on earned income up to $168,600, and this was the amount in 2024. We're working with the 2024 numbers. That changes every year. It's like 176 this year. Next year is going to be like 180 something. Keep chasing that max. That means that this only on income, earned income, so that would be wages and income from self-employment, up to $168,600 is subject to Social Security or OASDI tax. Once you reach that income level from earned income, and this applies to each individual, not each tax return, but each individual. So even married couples, each individual has to reach, they have their own wage base here. Each calendar year, each individual, once they exceed that amount, they no longer have to pay this tax. This is a regressive tax. We talked about that early in the semester, that difference between progressive taxes, regressive taxes, proportional taxes. This is a regressive tax. So once you reach that, your tax rate is 0. Now you've paid tax up to this amount, but after that, so if you make $168,601, that $1 over is not going to be subject to the Social Security tax. Medicare tax does not have any maximum. So it goes from the first dollar up to infinity of earned income. So even if you're no longer subject to Social Security tax, you may still be subject, well, you still will be subject to Medicare tax. Make $1 million, the amount over 168.6 isn't gonna be subject to Social Security tax, but all $1 million is going to be subject to Medicare tax. Additional Medicare tax applies, and it's only paid. So if you're self-employed, these are your tax rates. If you're an employee, these are your tax rates. So additional Medicare tax is on amounts earned over $200,000. Now that's per individual. Let's see, do they talk about additional Medicare tax on here? I may be getting ahead of myself. I just want to see if they talk about it down here because it does. All right, maybe they don't. It actually does matter what your filing status is. So if you are amounts earned over $200,000, if you are single, head of household, qualifying widow or widower, married filing separate, $250,000 if you are married filing joint. But the $250,000 applies to the whole return. Okay, it applies to both. So it's a marriage penalty because ordinarily you'd think, well, if I were single, I would get a $200,000 limit for each of us, but I'm married and together we have a $250,000 when that kicks in. So there's the tax rates there. They do talk about this. Additional Medicare tax of 0.9% imposed on self-employment income in excess of $250,000 for joint returns, $125 for married filing separately. $250,000 for joint, $200,000 for all other returns. If you recall, in payroll accounting, what we talked about was just this $200,000 limit, because in payroll, for the payroll professional, that's the limit they're using. If it turns out that that employee is married filing separately or married filing jointly, that's up to the employee on their personal tax return to make the correction. So if they're married filing separately, they're probably going to owe additional Medicare tax. If they're married filing jointly, they may get a refund of some of that additional Medicare tax that they paid because that limit was different. So from a payroll perspective, we use the $200,000 limit, but on the tax return, it depends on your filing status. Okay, and then again, that's reconciled on the individual tax return. All right, so these are the tax rates, and recall that for taxes, we've got, I'm going to erase these. They're up there, and you should know pretty well what they are. So those are the rates. And remember, in order to calculate our tax, what we do is we take our tax base times our rate to get to our tax. Okay? Now, again, in payroll accounting, we learned that our base is just whatever we earned. But for self-employment tax, it's actually a little bit different. So in payroll tax, we just took, like if somebody earned, if it was self-employment income and they earned $200,000, $200,000 would be our base. But that's not actually our base. What we get to do first is we get to subtract 7.65% of whatever our net income is to get to our base. So if our base was $200,000, or if our net income, so this would be line 31 of Schedule C is $200,000. We get to take 92.35% of that. So times 0.0765, which is, what is it, 1530? 15,300 is that. So then we would take our net income minus 15,300. So 184,007, whoops, it's a 7, not a 3. This is now our base. So what we're going to do with our net income, whatever is on line 31 on Schedule C, we're going to multiply that. Well, we could also multiply it by 92.35%. What I did here was I subtracted 7.65% of it. But if we take that, multiply it by 92.35%, this now becomes our base. So we essentially get a deduction for 7.65% of that, which is the tax rate for the employer of 1/2 of that 6.2% plus the 1.45%. Let's see. I will show you on the schedule. We have another schedule that we get to look at. This gets calculated on Schedule SE. Okay, that's where we calculate our self-employment tax. So if you look at that Schedule SE, you'll see the calculation of all this, and I'll show you that in a minute. Let's look at the example here. We've got Linda is employed at a local bank and has wages of $178,000 at her bank. So her bank is going to take out the Social Security and Medicare tax. They're going to take out Social Security. They're going to withhold Social Security tax up to $168,600, and then she's not going to be subject to it anymore. She also has a Schedule C business. She sells jewelry at night and on the weekends. She has net income, so that would be here, net income of $15,000. Linda owes no additional Social Security tax on that income because she's already over that 168.6 limit, right, with her wages. No Social Security tax. She only has to pay Medicare tax. She doesn't have to pay additional Medicare tax unless she was married filing separately. Then she would, but she doesn't have to. So she's only going to have to pay Medicare tax on the $15,000, which here's the calculation. So again, we're going to reduce that base by the 7.65%. That's what we're going to multiply by the tax rate of 2.9%. So she's going to pay $402 of Medicare tax on that $15,000 of self-employment income. So as I mentioned here, she paid Social Security and Medicare tax. She paid Social Security tax on $168,600 from her wages. This maximum earned income. This is for all sources of earned income combined in the year. So if you have multiple W-2s, and some Schedule C income, that's the maximum for everything combined. Now suppose that her wages from the bank were $79,200. Now she's not anywhere near that 168.6, right? In this case, that $15,000, she still gets to reduce it by the 7.65% to calculate what the base is. But now she's going to have to pay the 12.4% Social Security tax and the 2.9% Medicare tax on both of those. So she still has to pay the $402, but now she also has to pay $1,718 in Social Security tax on that $15,000. So this is where the regressive nature of it comes in. You can see, so she's paying $2,120 on that $15,000. Up here, she only had to pay $402 because she'd already exceeded the Social Security wage base. That schedule, what's this? Increase to SE. Oh, wow. So we use the Schedule SE, which accompanies every Schedule C. So this is what the Schedule SE looks like. So you usually start out on line 2. So your net profit or loss from Schedule C, line 31. That's what we're going to enter there. So once you've completed the Schedule C and you have line 31 entered, and remember, before you get to that point, you would have to figure out what your income was, what all of your expenses were. If you had any home office deduction as well, you have to figure out all your depreciation first from that business. Everything that we've talked about in this chapter, you'd have to figure that all out first before you can get to this point, because that line 31 is the end result of all those other calculations. So we get line 31 and we pop it here on the Schedule SE. Net profit or loss from Schedule C, line 31. So that's this. We'll pretend we had already done all that. Line 3, well, it's just going to be what line 2 is here. Line 4A, if line 3 is more than 0, because it could be more than 0. I mean, it could be less than 0. If you had a net loss, that's possible, right? If you had a net loss, you're not going to have any self-employment tax. But if you had net income, now we're going to multiply line 3 by 92.35%. So that's what I did here. I took the long way around and just subtracted I multiplied it by the 7.65%, which, by the way, 92.35 plus 7.6566 is 100%. That's where I got the 7.65% there. Multiplied by 92.35. So this amount is going to be subject to self-employment tax. So that's our adjusted base in this calculation of what our tax is. So 13,853. Here we're going to, let's see, 4B. Yeah, we don't have to do that. 4C, combine lines 4A and 4B. We have nothing in 4A. If it's less than $400, stop. You don't owe any self-employment tax. Well, that's nice. If your net income from self-employment is in total from all of your sources of self-employment income is less than $400, you don't have to pay self-employment tax. You don't have to pay the Social Security and Medicare tax on those amounts. If it is $400 or more, though, then you have to pay self-employment tax on all of it. So you don't then get to subtract the $400 from whatever your income was. You have to pay the tax on that. So combine lines 4A and 4B. If it's less than $400, stop. You don't owe self-employment tax. So 4C, we're just combining those two. So we're getting to the 13,853. Sorry. There's some special lines in here for church employees and for ministers, so they have special rules as well, but we're not going to do anything there. So if this was like 5 is if you were a church employee. So we're not, line 6, add lines 4C and 5B. We have nothing in 5B, so 13,853. So this is the amount of self-employment income that is subject to the tax. Then line 7, maximum amount of combined wages and self-employment earnings subject to Social Security tax, or the 6.2% portion of the 7.65% railroad tax. So this is that annual wage base for Social Security. What we're doing here is saying, okay, have we already met this 168.6? If so, then this amount is not subject to Social Security tax. It is still going to be subject to Medicare tax, but that's what we're doing here. So in this case, we're going to enter in, and that's going to be filled in. That's already filled in every year with that wage base amount, okay? Line 8A, total Social Security wages and tips, total of boxes 3 and 7 on forms W-2. So you're going to take all of the W-2s that were received and add them all up, all of that income that was in box 3, which box 3 on the W-2, if you recall, is the income that is subject to Social Security tax. So all of them, so if you have 6 W-2s, you're going to add up all of the box 3s on those 6 W-2s, enter that in here. Any unreported tips, if it wasn't listed on there, you'd enter those there. Wages, you're not going to enter, most times you're not going to enter anything on that 8B or 8C. Line 8D is just a total of all of those, so $79,200. Subtract line 8D from line 7. Essentially what this is this is the amount of additional income that you have to earn in order to get up to that wage base. How much more you would have to earn. So in this case, after the W-2s, this client would have to earn another $89,400 to get to that wage base. Multiply the smaller of line 6, how much was actually earned, or how much more she has to earn. So because that is smaller, so there's the $1,718 that we calculated earlier. That's the Social Security tax, and then multiply it by 2.9%. That's the Medicare tax. Total those two together. This is the total self-employment tax that this individual is going to pay on that additional $15,000 of self-employment income. $2,120. Now the last part of this, you don't want to forget, remember you get a deduction for half of your self-employment tax. Remember that from chapter 4? That was one of those adjustments to income that goes on the page 2 of the Schedule 1. Well, this is where you calculate that. So you take 1/2 of that line 12, that's what goes on line 13, and it tells you, enter it here and on Schedule 1, line 15. So it tells you where to enter it. Calculate it here and then put it on that other form. Okay? Each of these, all of the instructions are here if you read them carefully and you do all the calculations on each of these. I shouldn't say all the instructions. All the calculations are here. All the calculations that you need to do this properly are here. But before you can do this, you have to fill out the Schedule C completely, which means, again, you've got to calculate all the depreciation because that's one of the expenses that would go on the Schedule C. You've got to calculate any home office deduction because that flows onto the Schedule C. But there is an order to this stuff, but you've got to do those things first before you can do this Schedule SE. And then what happens, this line 12, self-employment tax. Enter it here and on Schedule 2, line 4 for the 1040. So this is a form that Schedule 2 is for additional taxes. So over and above income taxes. Remember, she's going to have to pay income tax. Actually, she doesn't get this deduction of 7.65% for income tax. She's going to pay income tax on the whole $15,000 in addition to the self-employment tax. Let's see. So this, I'm going to see if there's another. This is just an extended example here. I'm not going to go through this in detail. There's the SE. This is one where they've got self-employment income, so they've got you doing the whole thing with this example. I don't need to talk about that either. Okay, so that's self-employment tax. Any questions